Hey everyone, welcome to the video, and if you're new here, my name is Alex. Today, I'm going to be breaking down the RRSP, simply what it is, why it matters, your investment options, your contribution rules, but also the biggest advantages within the account, such as the home buyer's plan, the lifelong learning plan, and spousal RRSPs, and exactly how you can use this account the right way. Back when I worked in banking, I met many people who contributed to their RRSPs regularly, but years later felt confused, disappointed, or even angry because their money didn't grow very much, and now they're at the point of retirement where all their withdrawals are being taxed. It leaves them feeling like the RRSP is a bad product and that they have lost money. But the reality is, this usually just comes down to misunderstanding how the RRSP works, and not because the product is bad. By the end of this video, it will finally make sense and you will know exactly how you can apply this account to your own financial plan. So let's get started. What is an RRSP? The acronym stands for Registered Retirement Savings Plan. It is a government registered account that allows you to contribute pre-tax dollars today to lower your taxable income for this year and allows your investments to grow tax deferred, meaning you don't pay taxes on that growth until you withdraw. So just by looking at this process, we can clearly see that this account was intended to help you save for retirement. But it's not the only thing you can accomplish with this account. Think of the RRSP as a tax deferral and long-term savings machine. Also, in the year that you turn 71 years old, you will be forced to choose where the funds inside your RRSP will go. You have three options. You can either withdraw them, which I wouldn't recommend because you're going to pay a lot of taxes up front. You can transfer them to a RIF, or you can use them to purchase an annuity. Now, both of the last two options basically just give you a minimum that you must withdraw per year. Also, if your funds are invested when you're transferring to a RIF, don't worry, the investments will follow. Now let's talk about how much you can contribute to the account. Number one is 18% of your previous year's earned income. And number two is the annual CRA maximum, which for 2025 was $32,490. Now, for example, if you earned $80,000 last year, well, 18% of $80,000 equals to $14,400 in available contribution room, plus any unused contribution room from previous years, which carries forward forever. That's right, the contribution room that you don't use in previous years will carry forward indefinitely. This is extremely valuable for those with variable incomes or for those waiting for higher income years before contributing. Now, to check your limit accurately, you will have to either log into your CRA account or check your last notice of assessment to find the exact amount of contribution room available to you. Now, like in other government registered accounts, you do not want to over-contribute as there will be penalties. Over-contribution penalties are generally 1% on the over-contributed amount per month until that amount is either withdrawn from the account or new contribution room is added or earned to your RRSP. Now, there is a $2,000 buffer in the RRSP, which means that you will not incur any over-contribution penalties until you've exceeded more than $2,000 of over-contributed money. But don't even go there because this $2,000 won't even reduce your taxes anyway. There's really no point. So always verify your contribution room before making any large contributions to this account. A few important dates that you must understand about the RRSP is the contribution period begins on the 61st day of a year and ends on the 60th day of the following year. And contributions in those first 60 days can either be applied to last year's income or this year's income. This is incredibly useful for last-minute tax planning as you know the exact amount of your taxable income for the previous year. Now let's talk about how the RRSP tax advantages actually work. There are two major benefits. One is immediate tax deduction, and two is tax deferred investment growth. Now, because you contribute pre-tax dollars, your taxable income will be reduced. Depending on your employment status, this will either increase your refund or lower the taxes payable at the end of the year. For example, if you're in a roughly 30% marginal tax bracket and you contribute $10,000, you will save around $3,000 in taxes. So if you then reinvest that refund or the tax savings, that's how you accelerate compounding even faster. Now let's talk about when and why withdrawals are taxed. So it's very simple. RRSP withdrawals are taxed as income in the year that you withdraw. So timing matters. But look, the strategy is simple. You contribute when you're in a higher tax bracket, or usually when you're working, and then you withdraw when you're in a lower one, which means that you've either stopped working or you're at retirement. Now, the spread is called the tax rate arbitrage, and it is the fundamentally most important idea behind the RRSP. See, most people have lower income at retirement because their mortgage is paid, the kids are gone, and lifestyle expenses are lower, making retirement the ideal withdrawal period. But then withdrawing during working years can trigger some really high tax rates. During my time as an advisor, I have seen many cases where people come in, they claim to be going through a financial emergency, and they believe that the only solution is to withdraw from the RRSP. Now, I can tell you from experience, there is usually always a better option. I mean, think about it. If you're in a 30% tax bracket, you will be taxed 30% on this withdrawal immediately. Now, in the banking world, that's like taking out a loan at a 30% interest rate and only paying the interest portion for an entire year. Look, the point is there's usually a better option out there. If you're going through financial hardship, speak to a financial advisor. They'll be able to guide you in the right direction. Now let's talk about one of the main advantages in the RRSP, and it's called the home buyers plan. The home buyers plan will allow eligible first-time home buyers to withdraw up to $60,000 from their RRSP. And couples can combine to withdraw up to $120,000. However, this is not free money. This is basically just an interest-free loan that you are making to yourself, and you have 15 years to pay it back, starting as late as the second year after the withdrawal was made. Your annual repayment amount can be calculated as follows. So it's the total amount that you've borrowed over 15 years. That amount must be paid per year. Now, missing payments causes that portion to be counted as taxable income, basically treated the same way as if you withdrew from the account. Before we move on, I'd just like to mention that if you find this video helpful, please be sure to hit the like and subscribe button. It truly helps me out and I would really appreciate it, but that way you won't miss one of my future uploads once they're posted. That being said, let's jump back in. Now that we've covered the home buyers plan, let's compare it with the first home savings account. Now, the most common question people ask is which one should you use first? My advice is start with the first home savings account, and for 4 main reasons. Number 1 is your FHSA contribution room does not carry forward indefinitely once the eligible years expire. Basically, if you don't use it, you lose it. Number 2 is the RRSP contribution room does accumulate forever. So if you don't use it, you don't lose it. Number 3 is your FHSA funds can be transferred to your RRSP completely tax-free, even if you don't buy a qualifying home. And number 4 is you don't have to repay the FHSA. Now, in the perfect world, you can combine the home buyers plan with the FHSA for maximum tax savings and tax advantage when buying your first home. Let's talk about another advantage in the RRSP, and that is the lifelong learning plan. The LLP will allow you to withdraw from your RRSP to finance either your education or your spouse's education up to a $10,000 yearly limit, but up to a total limit of $20,000. Now here you only have 10 years to pay it back, but it's calculated the same way as in the home buyers plan. You take the total amount divided by 10. That amount has to be paid back per year. The latest you can start repaying the LLP withdrawals is in the 5th year after the first withdrawal was made. Important to note that there is no limit as to how many times you can use the LLP as long as you pay it back, and if it's under $20,000, you can use it again. So think of the LLP as an interest-free line of credit from yourself to yourself with a $20,000 limit and certain repayment rules. Now let's talk about spousal RRSPs and income splitting. A spousal RRSP is one of the most effective but also underused tax planning strategies in Canada. If one partner earns significantly more, then the higher income partner can contribute to a spousal RRSP and receive the tax deduction now for themselves, while the withdrawals in retirement will be taxed to the lower income partner, which reduces total household taxes. Just know the 3-year attribution rule states that if withdrawals occur within 3 years of contribution, then the income may be taxed back to the contributor. Really only do this if you know you are with the lifelong partner, or else this can get really messy. Now let's talk about the investment options inside the RRSP. This is also one of the most important ideas of the entire video. The RRSP is not the investment. It is just the account. When people are complaining that their RRSP isn't growing much, it's usually because it's just cash sitting inside the account, which is no different than keeping cash in your wallet or under your mattress or in a safe. It is slowly losing to inflation and it's not gaining any value. The solution is to invest it. Let's face it, if you're investing for retirement, then you're probably going to be invested for long term. And long term in the banking world can be defined as 10 years or more. If this is the case, then your goal should be to have your money work for you and grow over time. So inside the account, you can invest in things like ETFs, index funds, mutual funds, individual stocks, bonds, GICs. For most Canadians, I can say that a low-fee ETF is one of the most cost-effective ways to get great market exposure inside the RRSP. Keep management fees in mind because ETFs and index funds have much lower fees than mutual funds. Also, make sure that you do diversify because let's say you're invested in multiple hundreds of different companies and one of them tanks, you might not even notice. And last thing, if you're invested for the long term, then think long term. I know it sounds basic, but it is incredibly powerful. Think about which sector or which industry will be worth more in 10 years or will progress a lot in these 10 years. Now let's talk about some common mistakes that people make. I'm just going to fly by these real quick. Contributing without investing, that is the #1 growth killer. Your cash is just sitting inside earning almost nothing while it's also losing to inflation. Big loss. Over contributing, the penalty is 1% per month. Don't do it. Withdrawing early, this will destroy long-term compounding, usually taxed at higher rates depending on your tax situation. Spending refunds instead of reinvesting them, you're just missing out on one more opportunity. Using the RRSP when the TFSA may be more suitable. If you're investing for the short term, then use the TFSA. And trying to time the market. Look, you've heard it before, time in the market beats timing the market. And with that, that's the end of the video. If you found it helpful, please be sure to hit the like and subscribe button. It's truly the best way to help me out. I would really appreciate it. It will allow me to keep making no fluff financial and real estate content that may be suitable for you. If you have any questions or want a topic covered next, be sure to drop it in the comments. I read every single one. And with that being said, thanks for watching and I'll see you in the next one.